Let us now look at the other side of the balance sheet. So other side of the balance sheet, as we discussed little while ago, there are two components. The component number one is the non-current assets and the component number two is the current assets. So let's look at them one by one. Tangible assets or the property, plant and equipment. All of us are fully aware. So your land, building, property, plant and equipment, computer, furniture, all the tangible assets will be part of your tangible assets PPE. Then invariably all of you company secretaries, either in employment or in practice, you will also see sometime in the balance sheet a line item called CWIP. Now this CWIP, friends, stands for capital work in progress. Now what does it signify? It means that the company has undertaken a capital expenditure plan and for which company has incurred expenditure in on land, building and plant and machinery. And this capital expenditure or this facility or this plant on which this money has been incurred is not yet complete. So capital work in progress will mean the money is spent and some more money is yet to be spent before the facility becomes complete and company starts monetizing it. So that is capital work in progress. Please remember, on this amount of capital work in progress, will you charge the depreciation? Answer of course is no. And why will you not charge depreciation? Because the facility is yet to complete and it is yet to be put to use and therefore CWIP there will not be any depreciation. In due course what will happen? This capital work in progress, the project will become complete. So once the project is complete, land will be capitalized as land, building will be capitalized as building and plant and machinery will be capitalized as plant and machinery. So the CWIP figure will disappear and instead of CWIP figure, the new line items will come depending on where the money has been spent. If land is involved, plant and machinery is involved, building is involved, then you will have all those three line items coming. And of course you will not charge depreciation on land, but then you will start charging depreciation on the other components. Intangible assets, of course we have discussed and I am sure you all are aware as to what is intangible asset. Intangible assets under development, what does it mean? Very simple. So in case of development, in case of capital expenditure that you are incurring in creating physical assets, that will be referred as capital work in progress. But if you are also spending, let's say you have a company like Tata Motors or Maruti or all these automobile companies and all the companies as a matter of fact. So all these companies like Tata Motors or Honda or Hero or Maruti, they know that if they have to remain in business for a long time, they will need to keep on introducing new models every now and then. And so what they do, they spend money on design and development for new models. So whatever money has been spent on the development of new models, it will appear in the balance sheet as assets, intangible assets under development. And the moment this design is complete and company starts monetizing it, that means Maruti or Tata Motors, they start producing the vehicle as per this design, and then this intangible assets under development will switch over to tangible assets. So the amount of intangible assets under development will become zero and the amount of intangible assets will increase by the same amount. Non-current assets investment, of course, I'm sure you can understand. So non-current investment, what does it mean? I'm sure the definition of current and the non-current is still applicable. Current investment is one that the company has done with an intent to dispose it off as and when the company gets an opportunity for making profit on it. So the company has purchased share of company XYZ Limited, and why the company has purchased the shares of XYZ Limited? It has purchased the shares of XYZ Limited so that once the market price of the shares of XYZ Limited goes up in the market, they will dispose of those shares and make a profit on that actually. So that is your current investment. Non-current investments are what? Non-current investments are the investment which company has made in the other entities, not with an intent to dispose it off in next, whenever is possible, but to hold those investment for strategic reasons. So the investment into subsidiaries, investment into joint ventures, investment into associate companies that you make is will fall into the category of non-current investment, because you invest money into a subsidiary company not because you want to dispose it of, because you want the subsidiary to be with you and support your operations. So that's your non-current investments. Non-current investments are the investments made by the company where company intends to hold that investment for infinity. Okay, virtually for infinity, right? And then you have a long-term loans and advances. Please remember, don't get miscarried or confused by the term loans and advances. This loans and advances does not mean the loan that the company has taken or the advances that the company has taken. The loans and advances here means what the company has given to others. So remember, it is possible. Sometimes it does happen. A company, automobile company, right, or any other manufacturing company, they sometimes give advances to their vendors for developing certain products for them, right? And the vendor says, I do not have money, and the OEM say, no, I need this, you to supply me. So the OEM would tell the vendor, okay, I will give you the advance. With that advance, you purchase the plant and machinery and start producing component for me. So all the advances which are going to come back to the company beyond a period of 12 months will fall into the category of long-term loans and advances. Then we come to the current assets. Inventories we all understand, but remember, inventories here would mean raw material, work in progress, and also the finished goods. Trade receivables, we all are aware. So when we sell the products to our customer, obviously sometimes we have to give credit. So the money that is due to me from the customer on the date of the balance sheet will come in the balance sheet as current assets, and that's my trade receivable. Then we have an item called cash and cash equivalent. Cash we all understand. So money lying in cash lying in my box is cash, and the amount that is lying in my bank account is also cash. What is cash equivalent? So cash equivalent means something which is not cash, but it is not less than cash. That is cash equivalent. Meaning what? Meaning company has put deposits into the bank, fixed deposits for a period of 2 months, 3 months, 1 month. Now this money can come back to the company anytime the company decides. So it is not a cash, it is not lying into the bank account of the company, it is lying with the bank as a deposit, but it is cash equivalent. Likewise, company may have invested into certain securities, and company has the choice of of getting their money back against those securities at a short notice without any reduction in the value of those investment. That is referred as cash equivalent. Then you got a short-term loans and advances. I have already explained to you. So short-term loans and advances. Your employees go on travel, so you give them advances. That's your short-term advances. It will come here. Sometimes your employees come to you and they ask for advance against salary, and that advance also will come here, and you pay taxes in advance. That will also come as part of your short-term loans and advances. Other current assets, anything which is not fitting in the above, will be other current assets. And current investment, I think I have already explained to you as to what is the current investment. So friends, with this, what we have done, we have understood the balance sheet line by line, and the asset side as well as the liability side one by one, and that is understanding balance sheet for the purpose of financial strength evaluation. Now, very quickly, let us understand, or rather do a quick review. So when I'm discussing it with you, you can do it in your mind